So hello everyone, my name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So firstly, I'd like to thank all of you for giving us your valuable support. You've been watching all our shows and we're getting very good support from each one of you. So firstly, thank you for that. As you know, at AIF and PMS Experts India, we keep organizing these knowledge-based sessions and we call it Ask the Expert Show. So on our show, we have with us a very eminent speaker, Mr. Nilesh Doshi. He's a CEO and managing partner of Green Capital, LLP. So without any further ado, I'll take a minute to quickly introduce him and then probably we'll start with a couple of questions. And then will try and read his mind and try and understand that what are his views on the markets. So, Nilesh, in 1984, he's IIT Bombay batch, an engineer and researcher at heart. He has basically neck to not only identify large microeconomic trends much before others, but also to identify some of the high quality companies that would stand to benefit from them. Voracious reader, he is a highly knowledgeable personality who can talk on any subject with full of confidence because he keeps a track of both micro and micro. He brings about almost 3 decades of experience. Some of his, best companies that he picked up was Pidilite and Praxair and Flood Glass India. He's also done research at. He basically headed the research team at Techno Shares and Stocks, Way to Wealth Brokers, and Edelweiss Financials. And time and again, he has proven that whatever companies that he picks up delivers at least 5 to 10x. There are many examples that I can talk about. For example, in 2009-10, his top picks were like Hindustan Unilever and Cadila Healthcare, Jyoti Labs, TTK Prestige, Kaveri Seeds Company. And then between 2011 to 13 time during the Brexit time, he initiated coverage on companies like Naveen Flooring, International SRF Limited, KEI Industry, Subtros, CCL Products, NSL Propex. So they were those companies. I mean, he was sort of visionary in terms of identifying them at an early stage of their growth curve, and eventually those ideas, where they are. Or most of them are 10x now. Some of them would be 7 to 8x. So basically the idea is that one, he is, because of his stint in the industry more than 3 decades, he not only identifies these trends at an early stage, but also identifies some of the high quality companies at an early stage of their growth curve. And that is what I would say that clearly distinguish him from other peer group in the industry. So Nilesh, firstly, thank you so much for sort of accepting our request and taking the time out from a busy schedule. And I know that you don't get time to sort of interact, but basis my request, you've decided to give us 30 minutes for our investors. So thank you so much for accepting the request.
Yeah, thank you, Vikas, and thank you for such a nice introduction. I mean, whatever we have done in the past, probably, yes, it is. We put a lot of efforts and, as you said, trying to identify trends. So yes, we try and keep ourselves update of what's happening in the world. And luckily, we are good in technical and technological areas. When I say technical, not really market technicals, but the industry technology area, the changes, the trends, etc. So, welcome all friends on this webinar. I think though the title is like we want to share how we look at the businesses, but I think the what I understand internally and is that the broader questions in the mind of investors today, and I get every day many requests, questions, phone calls that is the market very expensive today?
Yeah.
Should we invest now going forward? Is it a bubble? And how do we navigate this entire scenario going forward? So that is how we thought that it's good to get into such discussions where maybe at larger level we can address and share our thought about how do we look at the market at the current scenario. Of course, we all know what has gone through since probably 2008 financial crisis and uh, last decade, and then COVID and post-COVID scenario. But yes, as the market from October, maybe say around 19,000 to 22,000 was a very sharp move. The questions sincerely is that what do we do it now from here? B, yes, on one side there is a lot of fear that the market is expensive, and on the other side there is a fear of missing out across the investors. And this is a very difficult scenario how to we look at forward. So I thought that okay, we'll take some time and share the way we think it.
Sure.
Uh, I'm not going through on the international front because there is a lot of happening in the US and the Western world, and geopolitical does impact the investing scenario purely because that we also have a lot of FII participation in our country. But in order to limit the discussion and to talk more about the way Indian scenario, I think I'll start with the India perspective first, and during that I'll drive the way we look at the market. So I think I'll
Yeah.
cover up all into this uh, broader
Yeah. So
thing.
that was the idea of
So
reading your mind over there. Yeah. Please go ahead.
yeah, sure, Vikas. So I'll take it as India macro, which is, although I have slides, but I think I'll take bullet points, is that we see it as very positive in a difficult world. The world is extremely challenging. Europe, we believe that it's structurally on a decline phase. And somewhere down the road, even US can get into a similar road, unless there is a new government post 2024 election, or if Trump comes back, maybe we'll have to relook at differently. Secondly, therefore, we see in India with the latest state election result, yes, the probability of political stability now appears very high, and therefore market has actually thumbs up that post the state election result, and which gives us a confidence that the policy reforms will continue with this stable government coming forward. Therefore, we expect that the domestic manufacturing will really gather pace if the same government comes in with a continuation of policies and improving policies. So in the areas like, because we have a lot of PLI scheme has been announced, outsourcing from developed world will increase, especially on the capital goods. Now, this time going forward, more on the capital goods than the engineering goods side. Last 7, 8 years, we have seen massive demand from developed world, from India on textiles, chemicals. The coming few years to a decade, we see this should happen on the engineering sector, manufacturing sector, and other engineering consulting areas. Third is make in India and self-reliance, especially from Atmanirbhar Bharat on the areas of defense, electric vehicle batteries, lithium, hydrogen, semiconductor. So these are the areas where we believe that the domestic manufacturing will come up in a very big way, and all this will result into a massive uh, manufacturing setup, capital infusion, capex, and all this will happen, which will cater also to the domestic needs as well as the exports in certain areas. Uh, Therefore, an infrastructure capex, of course, it will continue because without infrastructure capex, we will not be able to competitive in these areas on the global arena. And finally, the exports of IT, pharma, agriculture, chemicals, I think this will continue. So this is how we look at in the broader theme of Indian perspective, that 2024-25, we see this is the pattern in the Indian industry, which means there's a lot of capex we can expect on the manufacturing side. And the larger area where we see capex, which is coming in, one is we all know on the renewable energy side, generation, on the transmission side, then downstream petchem and the refining side also now it is catching up. We will also see other thermal and nuclear capacities coming up. Apart from PLI scheme in the pharmaceutical, PLI scheme in auto component, semiconductor, polysilicon manufacturing, silicon wafers, the solar glass and glass panels. So all this is expected to come up in a very big way. So when I delve into the sector, I think I will take up little into it. Having said this, now the question therefore arises that how do we look at the most interesting area for all of us is equity market, because this is where we put our investment and we make money. So, firstly, yes, lot depends on two important happening in the world. One is in India election for us. So India Lok Sabha election in May, April, May, whenever it comes. Yes, it is very critical. Although today we know the probability of this government remains is very high. So it is more or less positive with a higher probability unless something extremely black swan kind of an event takes place, which is not in the any visibility. The other important thing is important for equity market is the global equity market, and therefore US election also is very critical for world. Apart from that, there are many elections in this 2024. There is an election, I think, in Russia. We had seen election in Bangladesh recently. So this year is full of elections in many, many countries. So American election is equally important because if we see Trump coming back, probably the things would be very different on the industry side, and which could be very positive. Uh, if if the same government remains, then one needs to relook at it at that point of time. How the US economy will pan out going forward, because structurally the fiscal deficit is very high and there is no way to resolve it. Inflation and economic growth outlook, therefore, in US is actually a key to their own policy action, and their policy action in turn will also have some impact on the policy actions of countries in the world. And therefore, how do we now look at, or what do we think about our equity market? So I'll address this in two angles. One is if the consensus Nifty earnings for 2025, FY25 is around 1075.80. Yet no downgrade has come. Although just now the lever result came, which is more or less flat. IT results we have seen, HDFC Bank result we have seen. So we don't know. There could be a possibility of some downgrade, but overall, even if it remains within a band of 1050 to 1070, our market is forward looking around 20 times the Nifty and 2020.5. Now, historically, yes, we always say 20 forward is a bit expensive. But if we want to be a $5 trillion economy over the next 3 to 4 years, and the ground uh, actions are pointing towards that, because we are really creating a very large manufacturing base. Since we consume a lot of imported stuff in the country, right from petrochemicals to capital goods to a lot of intermediate chemicals, the domestic manufacturing is really becoming very interesting. And therefore, if we want to achieve that kind of a target, we expect our economy to grow at about 6-7% real GDP. And if we add about inflation, maybe we'll grow at 10-11% nominal. Therefore, in an economy which has a political stability, a very forward-looking reforms, and a very highly regulated banking system, uh, a very good, strong RBI, and entrepreneurship. And in a scenario like this, would someone exit equity as a thinking that it is FY25, it is little expensive, and then uh, after 1 year, and if the Nifty falls by 10-15%, he will come back and start buying. I think this is little difficult scenario. Because for the larger institutions, the impact cost is also very high. And since their cost of capital is also not, I mean, yes, the interest rates are high, but they understand that they have to diversify in the investment horizon area. So we are not sure that really people will do that. People will run away from Indian equity market and then do what? Like if we are worried about Indian equity market, if it is expensive, let's say on a Nifty angle, then what do? We sell and then wait for Nifty to come down. And what if it doesn't come down? What we get a re-rating for political stability? What if US fiscal deficit is rising, and if they have to borrow this money on a yearly basis, then there is going to be a crowd out happening in the US, and you may see the dollar weakening at some point of time. So when all those things are happening, our view is that there is a possibility that Nifty may remain sideways for some time, or volatility, what we are seeing over last few weeks. And there is a possibility that individual stocks can have a big volatility. Because yes, especially in Nifty 50, there are a lot of stocks which, with the growth rate not happening, particularly let's say IT or banking at the moment, but banking overall should not be a worry. Like long-term banking should not be a concern. But near term, yes, your price is valued at perfection. There is no room for error we provide. And then if something little negative comes on the expectation side, I think the volatility will happen on the downside. Similarly, we have seen on the upside also. We have seen how today, I think Oracle Finance in the last 2 days have gone up by 25%. So where you are not expecting and there is a massive surprise, the market is going to behave other way. So, because overall it is possible that individual stocks will behave either way, depending on how but beyond a point, I don't think people will run away by selling HDFC Bank. I mean, if India is surely going to grow at, I mean, if we all believe it's going to grow at 10% nominal, then we will see a lot of capital infusion happening from even all over the world into India. See, without which we will not grow. So we will have an FII, FDI inflows coming in a very big way. And probably we are seeing some signs, early signs. And I think the global entrepreneurs are waiting for our Lok Sabha elections in a bigger way. Once that election will happen, probably the things could change very differently. Because everybody is waiting at the door in our learning and our reading. So that this suggests that very difficult to predict what will happen on a Nifty or even on the market, but probability suggests that we can remain, maybe we can remain a little volatile and on the sideways. But when such things happen, wherever the businesses are turning around, businesses have revenue growth and the margin expansion, market will reward those businesses during such times. And that is where we focus, and that is where we request or suggest that even investors should focus rather than worrying too much on Nifty and all. And we are seeing last 2-3 days, I think, even with HDFC Bank fallout, you see a lot of mid caps have been back in green, and in fact, there are some who have gone up. So the way the market is behaving is that market is not saying that I write off India as an equity asset class. And it is also saying that wherever we expect there is a growth, there is a revenue earning, there could be an export potential, which I said in the areas earlier I explained. I think market will continue to do well. We may see market to be little narrow in behavior from sectoral point of view. Certain sectors only will do well, and certain sectors may remain sideways to wait for the next trigger point or next bull market unfolding in those areas. that is happening, and that always happens. So we call it as a sectoral rotation in our parlance. So that those kind of things can happen. But opportunity to investment will remain. Yes. One has to do a lot of hard work, understand the businesses, understand sectors, understand the internal value chain of the sectors, the potential earnings. So if you put all this into learning, though, I think there are opportunities available. And so this is on the like overall thing. Let me add if there are some different pictures.
Yeah, yeah,
Uh,
please take your time.
so one is because there is one observation we have for last 3-4 years is that retail direct participation in the market is rising. Okay,
Yeah,
and they have made a lot of money. In fact, people who have put money into passive or a lot of large mutual funds, I think have underperformed. Whereas those who have been very active, good in stock picking, and direct retail, I think that is where the money was made by a lot of retail people across. And we see this trend to continue. So coming decade, we believe is of retail participation. This is one.
you
Second
have
is
SIP numbers, that SIP $2 billion of SIP inflow coming to
uh,
market. Is that what you're saying?
SIP will also continue. Now, since you have taken that question on SIP, what could happen is that the mutual fund will also have to change the strategy. If they see that they have been underperforming relatively to active fund managers today, uh, money is not going to close down. I mean, because yes, there are people who want to play with less volatility and little less risk, will keep going to mutual fund. And I'm not against that. But in turn, mutual fund will also have to change their strategy towards the areas which I explained, which they have, at the moment, a lot of people, a lot of mutual fund, a lot of investors have missed out. Some retail could participate, like retail could participate very well in defense, in railways, in energy sector, but in certain large funds, HNIs, ultra HNIs or mutual funds have missed out because their focus has always remained on quality and growth. Whereas the cyclicality, for whatever reason, it has been missed out by some. And therefore, we believe that if the India story and Indian growth is going to continue, then I use a term called Indian hard assets. So Indian hard assets will get re-rating. In last decade, we re-rated Indian brand assets or Indian, I would say, growth and ROC asset, high ROC asset.
Maybe
Now,
because
what
market
will
was in
happen?
fearful situation. Is that because of that?
Pardon?
Maybe because market was in fearful situation during the last decade. Is it because of that those hard assets were given the
Uh,
value?
No, it is because that the hard assets was not remunerative and was not generating cash flows and returns. Plus, post 2008 crisis, a lot of hard assets were into trouble zone. Okay, and even we were growing 5-6%, but that was not sufficient for in terms of areas like mining, energy. Okay, and the world over there was no capital formation that was happening. Now, what is happening is post-COVID that capex cycle world over is coming up, and geopolitical tension plus trade war with China, and finally Ukraine-Russia war, and now the next war. The self-reliance is becoming a key part of manufacturing happening all over the world for their own safety. So, for example, US is putting something like 60-70 billion dollars on their semiconductor area. So this is, and then the government is providing massive subsidy for that. So this is going to happen. Whether you like it, you don't like it, whether your cost of making internally is going to be expensive or not, self-reliance has to happen. So this is where the capex has started. On top of that, we marketed and the narrative was we make electric vehicles in a big way, and then we wanted green energy. ESG, and carbon neutrality. So all that has resulted into a good amount of capital formation in the Western world, including China. And then the Ukraine war and the trade war also suggested that they have to accelerate this process of self-reliance and manufacturing. And this is happening across the world simultaneously. This has never happened in the history of world, that across the world, every country starts doing green energy capex, EV capex, batteries capex, mining capex. So this has started all over the world, including electricity generation through green route, hydrogen, so many things. And this is creating a accelerated and concentrated demand for certain businesses. And if we can identify those businesses, the money making is going to be easy and fantastic because the tailwind is going to be very high. So this is one. And overall, we like, let me say that we will continue to see volatility, which we have to be prepared. So investment with little longer term horizon, with conviction and probably selective areas, if you restrict yourself, the money making would be better, and maybe there we'll be able to generate alpha. So this is more on the market side. And finally, with respect to last few years, maybe this year we have to little tone down our expectations from the market because the number of sectors which are going to perform will narrow down, at least for 2024. Post-US election, things can be very different. And therefore, as we come towards 2004 calendar year end, we will have to revisit in terms of strategies. Of course, during the year also, we'll have to keep relooking at our strategies. But at the moment, we see this is what is thematically going to pan out in the world equity market. So what should be a strategy for investment is that what we as Green Lantern approach to it.
Yeah, how do
We
you
have
do
both.
it? Yeah.
Yeah, so we have both kind of strategies, largely top down, and there are a few bottom up strategies. So in the team internally, we are four partners. Out of that, Nitin is one, who takes care of more of marketing and client facing. Other colleagues of mine, Abhishek and Pradeep, who are stalwarts and have been fund managers in the industry, in the mutual fund industry for almost 15 to 20 years. So we all three uh, basically cover all the sectors since we have a very deep and wide experience. And then we have a support team. So we do active management, and our approach is always whether it is a top down or a bottom up, it is basically a stock picking. As you were narrating initially in your earlier remarks about we identify sectors, this is what we keep doing all of the time. So like in 2009, probably when I was earlier on the sell side research in my earlier uh, profile, I was probably first one to talk of pharma sector as an investment in 2000, early 9, when we were just coming out of 2008 crisis and people were bleeding. 2009 and 2010, I was first one to talk about FMCG sector. 2012, 13, we started talking of chemicals and textiles. So when you identify an early trend, I think that makes your job a little easy. Of course, we keep ourselves aware of what's happening in the world regularly. All three of us spend a lot of time in global reading, macro reading. Nowadays, you get a lot of data and interviews of big stalwarts, right from Bill Gates to Elon Musk to so many people, Stanley Druckenmiller on the YouTube. So you listen to them, you understand what big people are thinking, you understand how India is participating and panning out, and this helps you to identify sectors. So, like for example, 2021 and we probably exited our IT portfolio, and we said the money would be made big way in capital goods.
Right.
And that is exactly what has happened. Like right from large cap in capital goods ABB, who has gone up by 4x, Elecon Engineering has gone up by 40x. So you get these kind of opportunities in the market. Yes, you have to do a lot of work. So we are very active in basically sector identification. And then we understand full value. We always spend time to understand the value chain within the sector. We all discuss with mapping every value chain in the entire sector, uh, uh, even indirect correlations, etc. And then we internally keep monitoring those businesses. And whenever we feel that the time comes right, we invest into those stocks. It's not that once we decided we jump into it. We constantly keep evaluating those businesses. We read, we study their quarterly numbers, we talk to the management, and where we feel that now we are close to unfolding what we are believing, we get into that. So what it helps us is that when our investment relatively early, before the public or market realizes, before the quarterly number comes to support that, and it gives a lot of margin of safety to us. So typically we have been little early. Like will not discuss any stocks in this forum,
Yeah.
but I can take a broader discussion that like ABB we had invested when the stock price was 1200 rupees. People were not even wanting to look at it. So this is how we identify, we understand the businesses, how it is going to expect it to turn around. Of course, you do go wrong in your hypothesis many a time. It's not that we are God, but if we go wrong, our downside risk is largely protected. Because if the sector is coming out, two things can happen. Your downside risk is protected if you are totally wrong, or you may be wrong for a time. Like the unfolding event may not happen for a quarter or two, but at some point it will get delayed, but it will happen.
I have a
So this is
question
what
here,
we do.
if you allow me. I have a question.
Sure.
So you pick up the trend first, or you pick up the company first and then work on the
We
trend?
always, so in a top-down approach, we pick up the trend. Then within the trend, we find which companies will be beneficiary earlier and which will be at a later part of the business. So let's say, for example, energy sector. Then if you say energy sector is positive, the transmission part of the sector will unfold little later. But capex part will unfold, the utility capex part will unfold little earlier. So like solar and wind plant capacity creation will unfold earlier, but transmission can happen little later, depending on the time you take to put up those capacities or those projects. So we try and understand, identify trend earlier, and then we focus all the companies within that sector, all, practically all, and especially all the best ones we start with. So this always gives you basically a good margin of safety, and your risk reward is very, very favorable in such scenario. So this is what we do it. And then and in the bottom up cycle also, we do very similar, that we expect revenue growth to kick in. We expect earnings growth to kick in. And then the stock should be undiscovered or uncovered. So where your risk is really controlled. So this is what our strategy is. And other thing what I can share with investors is that when you do this, especially on a top-down approach, there's a lot of tailwind also. So, and that tailwind basically takes care of some inefficiencies within the sector. So that helps. Like if anybody would have seen chemical sector from 2012, 13, uh, I think Navin Fluorine for us has been almost 100 beggar. And Deepak Nitrate was probably 150 times, not even 100, from 22 rupees to 3,200 rupees. So, solar industry, I mean, we would have studied, and I had a report in 2009, and I think the price was 100 rupees, probably. So, early trend identification, sectoral identification does help you. to protect your downside risk, which is also very critical in the market. And then your horizon has to be medium to long term in the process. And keep evaluating the businesses on a regular basis because that also helps you. And finally, the strategy which we adopt internally is also that we do a good analysis and understanding. So we have a position sizing is also a critical for a portfolio management. So even if we feel that we have three aces in a stock, we restrict to certain sizing in the stock to protect the investors' capital. We do reasonably good diversification also. Uh, and finally, the continuous monitoring of the businesses, the quarterly numbers, we continue to do that. So I think this is in nutshell, I've summarized it. Maybe we
Yes.
can take questions.
Sure. So a couple of quick questions, sort of rapid fire, if you're okay and comfortable. So do you ever take cash calls in the strategy?
So we never take cash call. I think that's a very good question. We don't take cash call, but at the same time, we portray ourselves as we are not a compulsive investor. Okay. So if we don't have ideas on the table, we may remain on cash. And we know that it is not a cash call for the market point of view. Because we have generally seen that if the investment hypothesis where you have invested, if there is a revenue and earnings growth coming, in your probability of that modeling is very high in your learning curve, eventually the stocks will reward. So there could be a volatility because of the market volatility, but the stock does come back. So our focus is on revenue and earnings growth. And second, we do sell stocks at certain valuations and profit. Uh, we don't generally buy stock for a re-rating purpose. So like we will not buy at 60 and believe that this will become 80 multiple and then somebody will relieve me at 80 multiple. So at some point, based on our macroeconomic thinking or the business learning that the business is discounting the earnings for next 3 to 4 years well in advance, which is probably happening in the market today, largely, because the speed at which market is moving is unbelievable. I think we use word, this is a raging bull market we have never seen in the history. The stocks does triple 4x, 3x, 4x, 6x in a span of 8, 9, 10 months. So if the valuation catches up too early, then our modeling, yes, we do sell the stock, and then so that may result in some cash in the portfolio, but that's not we don't term as a market cash call.
Sure. And the next question is, as a house, you have two different strategies. One is more towards largish mid cap, large and largish mid cap, and the other one is mid and small cap. And as you speak, you have now almost 5 years of track record in terms of delivering perhaps the highest return in the category on the mid and small cap side. Now, when investors are investing, uh, what would be your suggestion? What kind of strategy they should look at? Of course, we keep look at their risk appetite, etc. So as an advisor, we do share our views. But what should be the right time horizon, and what should be the realistic expectation? You have anything in that sort of, if you can guide?
Yes, so time horizon, we always say that the investment typically should be any stock we invest with a belief that we should get decent return, and then our time horizon is minimum 2 years and upward into a stock. But having said that, the experience in last 2 3 years of the market is extremely different. We cannot ignore that because uh, it is I'm like we are seeing every day in day out. It is unbelievable. The stocks goes up by 4, 5, 10 times in a very fastest way. We have seen in railways, we have seen in defense sector, in many areas. So that may result into little shorter time horizon at times, not always. But yes, our investment hypothesis, we typically work with 2 to 3 years in mindset and longer. But longer is always subject to you keep evolving, keep reviewing the businesses constantly. As regards expectation, I think I would not put percentage to that, but we are here to find stocks basically. Our idea is to do good stock picking. And as I explained earlier, if we focus on revenue and earnings growth and little early than the market, I think we are positive that we'll do better. We hope, seriously, we hope. And we pray God that He gives us those kind of ability to continue. So I think that is what our, rather than putting a number on the expectation. And between the two strategies, uh, the large mid cap strategy is for probably investors who cannot see volatility into the, because one must remember, all investors must remember that small and mid cap always behave in a step function. So for months it will not do anything, and with good numbers and something it will jump up fast. So basically, the small and mid cap behaves in a step way, whereas the large mid cap behaves in a very slow and steady rising pattern. So we should, if whatever is the temperament of the investor, that should do. Because we are not today in a scenario that we will not be able to find stocks in either of the scheme. I think we are able to manage it reasonably well even today. And then in the small and mid cap, I would say there also we have some large caps, because if we find good stock ideas, we do some. So we have some 10-15% of large cap also in that. So basically, uh, though when we started, we thought we are good stock pickers, so we said small and mid cap as a title. But as a strategy, we are multi cap sort of a strategy, and multi sectors. So both helps us to navigate in a proper way.
So in the sense that you have sort of flexibility even on your large and mid caps to add some small caps in future. Is that correct?
No, so in large and mid cap, we will not add small cap. But in small and mid cap, we may add little bit of some large mid caps.
Okay. Depending upon the kind of valuations.
Depending on the, yeah.
Okay. Okay. The other question is, so in the mid and small cap, what would be your priority? Since you talked about sizing, so how many stocks you'd like to hold for your
Yeah.
investment?
Yeah. So with experience, we have learned, and we have basically 18 to 20 stocks. So we don't have like mutual fund. We are not on 100, 120, 30 stocks. So we have between 18, 22 stocks. Uh, so average, you can say 18, 20 stocks. Uh, and as I explained in position sizing, even if we have best of visibility, we restrict to certain sizing in the portfolio for that stock. So you will find stocks between 2 to 3% to 8% of the portfolio.
Okay. Okay. Couple of questions from investors. So quickly, one is that how do you communicate with your clients? Do you have a newsletter or you do any con call ever? How do you communicate?
So earlier we used to have a quarterly newsletter, but I think of late we have stopped that because we are focusing and busy more on the research and conference calls and those and management meets.
Yeah.
So maybe we'll look at that if we have to restart it. Otherwise, on a performance side, you get monthly reports, so that is there.
Right. The other question I am taking myself this question. So, what percentage of cash you are holding? It depends on client to client, Neeraj. If client has come in just now, may have some cash component, and maybe the old client may not have. So it depends on the client. So I think I've answered that. Uh, I understand that your returns are not guaranteed, but what kind of numbers internally you have it in your mind looking at ROEs of the stocks? So would you like to take on throw some lights?
Because like यार पैसा तो सबको बनाना है, तो we would say यार I would want to make infinity. That does not work. So I think our approach is simple, because if we follow this process of investment, we strongly believe with our experience for so many years, all three of us believe that your process of investment should be right. And if your process of investment is right, the output the output is only money. Output is profit. There is nothing else in your process of investment. So if we follow that, I think we would want to, like, of course, we would want to work and do better always.
Sure.
And probably that you are seeing for last 4-5 years return.
True. The other question is, so when you talk about active management, so what is the kind of churning ratio you have it in the portfolio?
So our current churning is about 1.12. But that is because, as I explained to you, is the current market phenomena we must understand. It is very different. If the investors who observe in the market uh, and then they map the stocks to stock, you will find that the speed at which stock uh, discounts future is unbelievable. I think people must appreciate that. And therefore, we have uh, attempted in the last few years, 2-3 years, is that we don't do keep riding a stock just because it is a good stock. Yes, it is a good stock, but we don't want to keep riding beyond the extreme valuations. And so far, we have been able to identify because other stocks at a reasonable, extremely full margin of very good margin of safety. So that of course lures you that if a stock you have bought at, let's say, 10 rupees, and in 4 months if it becomes 45 rupees, and then this 45 rupees discounts the stock for FY27 earning, let's say, then should I wait for FY27 earning from that 45 to become 60? Whereas if I get another stock at 10 rupees, and which has a potential to go to even 20 or even by 25-30% year over year. Because my margin of safety, that's exactly what happened in HDFC Bank. Like, your price to perfection was very high. So all the best of the expectations were built into the stock at that point of time. So that is what it is. But we have a lot of stocks which we have been holding for more than 1.5 years today.
The other thing is the client is mentioning that there was a discussion that you have some sort of size constraint, as in you don't want to take too much of money on the strategies. Is there any concern on either of the strategies? Never, no? Okay.
No, we are basically what?
300.
See, around 330 or 40 crore today, right? And we feel that even up to this strategy, we can definitely work to a size of almost 2,000 crore. It's not difficult. Because if you see our portfolio, our average, if I exclude the large cap in the portfolio, our average market cap is about 10,000 crore?
No, 20,000.
20,000 crore.
20 on which one? The large and mid or
Small growth,
small
small and growth.
growth fund? Okay.
Yeah. So for that sizing, we can manage to this kind of. So I don't think we have that kind of a constraint today.
Right. So you have enough liquidity on those stocks which are bought.
Yeah, exactly.
Sure. I think with that, we'll like to conclude the session here. It was pleasure reading your mind, Nileshji. Thank you for enlightening us with your thought process and the kind of outlook you've shared, both domestic and global. Certainly would help all our investors to create long-term wealth. So thank you once again, and thank you for joining the call.
Yeah, thank you, Vikas. Let's keep in touch. Yeah.